In 2023, a couple in Ohio sold stock they'd held for 6 years. They made $31,000 on that sale, and they paid capital gains tax on every single dollar of it. Here's the thing, they didn't have to pay a single cent. Not because of a loophole, not because of some offshore account or a tax attorney charging $400 an hour, because there is a 0% federal capital gains tax bracket written directly into the United States tax code, and this couple, like millions of Americans, had no idea it applied to them. This video is for educational purposes only, not financial advice. Always consult a qualified tax professional for your specific situation. So what is this bracket? Who actually qualifies? And why are so many middle-class Americans writing checks to the IRS they legally do not owe? Let's get into it. Most people think capital gains taxes work the same way income taxes do. You make money, the government takes a cut. End of story. But capital gains, specifically long-term capital gains, meaning gains on assets you've held for more than 1 year, are taxed on a completely separate rate schedule. And that schedule has 3 tiers: 0%, 15%, and 20%. Now, here's where it gets interesting. That 0% tier isn't just for people in poverty. For 2024, a single filer can have up to $47,025 in taxable income and pay 0 federal tax on long-term capital gains. For married couples filing jointly, that number is $94,050. Think about what taxable income actually means here. It's not your gross salary, it's what's left after your standard deduction, which, in 2024, is $14,600 for single filers and $29,200 for married couples. So a married household earning up to about $123,000 in wages could still qualify for 0% on their investment gains, depending on their full tax picture. That's not a low income. That's solidly middle class. So why doesn't everyone know this? Because the financial media spends most of its time talking about the 15% rate, which is where most investors eventually land. The 0% bracket gets almost no attention, and the brokerage platforms don't remind you about it when you sell. The IRS certainly isn't calling you. Which brings me to you. If you've sold investments in the last few years, or if you're planning to sell something this year, there's a real chance this bracket already applies to your situation. Have you ever sold stock or an investment and assumed you owed taxes without actually checking the threshold? Drop that in the comments. You might be surprised how many people in this community have been in the exact same spot. Here's how this actually works in practice, because the mechanics matter. Capital gains tax is calculated on your taxable income, and your long-term gains sit on top of your ordinary income. So the question isn't just, what did I earn from investments? The question is, where do my total earnings land on the rate schedule after deductions? Say you're single, you earn $55,000 in wages. You take the standard deduction of $14,600. Your taxable income is now $40,400. That is below the $47,025 threshold, which means if you sell stock this year at a long-term gain, you pay 0 federal capital gains tax on it, up to the point where the gain itself pushes your taxable income above that threshold. And here's the part most people completely miss. You can strategically harvest gains in a low-income year. If you took a career break, changed jobs, went part-time, had a year with lower bonus income, those are the years to look at your brokerage account. Those are the years to think about realizing gains. This is called tax gain harvesting. Most people have heard of tax loss harvesting, where you sell losing positions to offset gains. Tax gain harvesting is the opposite. You intentionally realize gains during a year when your income is low enough to keep you in the 0% bracket. Here's the channel's take on this. Most middle-class investors are playing defense with their taxes. They're trying to avoid owing more. But the 0% bracket is an offensive tool. It's a chance to reset your cost basis on positions you want to keep, realize gains tax-free, and potentially rebalance your portfolio without a tax penalty. That's a completely different way of thinking about it. And it's legal. It's in the code. The legislation is the Tax Cuts and Jobs Act of 2017, which restructured how long-term capital gains rates are indexed, and the thresholds adjust for inflation each year, which is why the 2024 number is different from 2023. If this changed how you think about capital gains, Subscribe. One financial story per week, built for people who are still building wealth, not people who already have it. We break down the parts of the tax code that actually affect your balance sheet, the ones your brokerage isn't explaining. 2 things you can do right now. First, pull up your current year's estimated taxable income. You can use your most recent pay stub and the IRS standard deduction for 2024 to get a rough number. If you're a single filer and that number looks like it'll land under $47,000 or under $94,000 for married filing jointly, talk to a tax professional about whether realizing some long-term gains before December 31st makes sense for you. Second, check the holding period on your biggest positions. Long-term treatment only applies to assets held more than 1 year. If something you're thinking of selling is sitting at 360 days, waiting 2 more weeks could be the difference between your ordinary income rate and 0. Some people in this situation also use this window to move gains out of a taxable brokerage and fund a Roth IRA conversion strategy, or to rebalance toward lower-cost index funds without the tax drag they were afraid of. None of this requires a complex strategy. It just requires knowing the number. The 0% bracket exists. It's real, it's legal, and it's available to more middle-class Americans than most people realize. And here's the next piece of this puzzle. There's a tax move that pairs directly with everything we just covered, and most people only find out about it after they've already missed the deadline. That video is already on the channel.